I'm going to start with my presentation, the devil's advocate and four-pot portfolio theory. I could read it again, but I think we've got the message, and I made a mess of the last one, so I'll probably move on in the interests of time, particularly. So those are the topics I'm going to cover. So what's the consensus view? Because in the end, that's slightly what we're all benchmarked against, and that's what's driving markets right now. So I'm going to try and do is stress test that consensus view. I'm not going to say that it's wrong, but I'm going to say that we all need to think about what's driving markets now and whether the market's crystal ball is indeed as powerful as it would like it to be. So there is clearly a strong belief that under the new president there'll be fiscal stimulus, there'll be financial deregulation. The Federal Reserve, although it is tightening monetary policy very gently, it's doing it very slowly, and we are still at peak quantitative easing, as we'll see shortly. And as a result of this reform, tax cutting and deregulation package, the world's largest economy, the world's largest stock market, the world's largest bond market, will help drive global GDP growth, accelerate inflation, and therefore, in principle, if history is any guide, that's an environment that should be, in principle, pretty good for equities, pretty good for the dollar, not so good for bonds, gold, or cash. So that's the consensus view, and actually, to be fair, net-net, it's not worked out too badly so far, certainly even just in the last 6 months, since the election of President Trump. So that's really what's driving markets right now. And that's what I'm going to be stress testing. And certainly as a result of this, there is an awful lot of confidence out there and not very much fear. In fact, since I drew this chart just a week ago, which is of the VIX index, the 30-day options volatility index that's in the trades in the States, it's known as the fear index. The VIX index is trading now actually at 9.8, way below its long-run average of 20. And in fact, I think there's about 0.5% of all days trading has the VIX now traded lower. So nobody, it seems, is expecting any volatility. But clearly the warning sign here, that, by the way, is when Lehman Brothers went down in September 2008, when there was an awful lot of fear out there. But clearly nobody's expecting any skeletons or anything nasty to come out of the cupboard right now, even if history does suggest when the VIX does get down here, there is perhaps, you can see there's a fairly good inverse correlation between the VIX and the S&P 500, and where America goes, we all tend to go anyway. So it would suggest that when the VIX is down here, it's probably when you need to be at your most careful, not at your most carefree. And there are a range of possible endings. I'm a history student. I read all sorts of different stuff. This is Johann Wolfgang von Goethe. And this is Mephistopheles. Now, those of you who know your Faust will remember from the first part of the play that the good doctor sells his soul to the devil in exchange for all sorts of wonderful things. The less well-known part of Faust is the second one, when the Holy Roman Empire is on its knees, economically speaking, and this nice man goes to the emperor and says, "Tell you what, this gold stuff's rubbish. Let's get rid of it and print money and print our way out of trouble. What could possibly go wrong?" Well, if a 90, and of course the net result is everybody spends like fury, and then the whole thing drops in a massive heap, and the Holy Roman Empire is ruined. So if a 19th century German playwright knew that that was what was going to happen, I'm sure nobody else is going to make the same mistake again. So, a little bit of devil's advocacy for you. That's the link to that. Oh, Mephistopheles to President Trump, which some people may think is a link, but it isn't. So again, this is what the president is targeting. This is the consensus. This is what he's looking to achieve. This is what the market's looking for, to a degree, maybe even partly pricing in. Tax cuts, deregulation, infrastructure spending, work on the immigration. The healthcare bill may or may not now be going through, the repeal and reform of Obamacare, with the goal, as outlined by Treasury Secretary Steve Mnuchin, 3% plus GDP growth. In the end, he's only been in power for, 3 or 4 months. One shouldn't expect miracles. You could say that things have got off to a slow start with the worst Q1 GDP, with the worst GDP growth number for 3 or 4 years. But one can hardly pin that on the president when he'd only just taken office. But it does show, in some respects at least, he's working from a pretty low base, which has got to be something in his favor. Because overall, despite everything that the Fed's thrown at things, you've had a pretty patchy last 3 or 4 years, economically speaking. Now, of course, so this is the consensus view, and as we all know, markets love a really, really strong narrative. This is a quote from Mr. Buffett, of all people. "A pack of lemmings looks like a group of rugged individualists compared to Wall Street when the street gets a concept in its teeth." And the street's concept right now is clearly more growth is coming in the US and worldwide. What I would politely point out is that for all of Trump's good intentions, and I think generally speaking they are good, he's inherited an extremely sticky wicket, and one that may actually not be conducive to achieving what he wishes to achieve. He's been compared very regularly to Ronald Reagan for a similar tax-cutting, deregulating, and potentially budget deficit expanding program to get the US economy going. But as you can see here, when Reagan took over, interest rates were 18% and going down. Inflation, treasury yields were at 15% and going down. Inflation was at about 8% and going down. Debt to GDP was low. There's inflation. And Reagan took over after a 2 or 3 year bear market, whereby US stocks are on a trend valuation of 9. Trump's taking over. Well, interest rates in theory are going to go one way and that's up. Inflation is going to go one way and that's up. He's got an awful lot less room for manoeuvre when it comes to debt to GDP. And he's taking over after an 8-year bull run that means stocks have only been twice more expensive in their entire history. So the lemmings may have to be a little bit careful which cliff they jump over looking at that particular set of statistics, which means it's not necessarily going to be straightforward for growth to appear out of the blue sky and for equities to continue powering ahead looking at that particular set of data, hence the devil's advocate theme for the presentation. Just a few other things. This is tax. This is from Fred. It's all free, the St. Louis Federal Reserve database. It takes some time to get the numbers out, but you can. As we can see here, tax paid as a percentage of Americans' corporation sales is already at extremely low levels, around 2.5%, 3% right now. So even the tax cut from 35% to 15% that Mnuchin is talking about equates to around 11% of US corporate profits. Well, given that the S&P 500 is up 13% since Trump took over, it's kind of in the price, right? In addition to this, US tax receipts. If the US economy was really booming right now, you'd expect US corporate and household tax receipts to be growing quite healthily. They're not. And what you also see is that US credit card use is starting to accelerate quite rapidly, something that you've actually tended to see just heading into recessions. It generally means that people are having to use their credit cards to pay for day-to-day things like groceries and fuel, not just life's little luxuries. So there are some warning signs that all may not be entirely healthy in the US economy. It certainly doesn't feel like it's about to suddenly take flight, as perhaps the consensus would like to believe. Car sales. Yeah, that really doesn't look very good at all. That's been a huge driver of US GDP growth over the last 3 or 4 years. And again, this is perhaps a sign that the US consumer is seriously tapped out when it comes to their abilities to borrow. And certainly the ones I would look at, this is since Reagan. Auto credit has just crossed the $1 trillion mark for the first time. Student credit is bearing down on $1.5 trillion for the first time. Somebody's going to have to pay the piper in the end, you would think. So again, Trump, for all of his good intentions, may not have as much room for maneuver as we would like to think. This is a final one from the weekly blog from American fund manager John Hussman, who I know has got a reputation of being a perma-bear, which I personally think is unmerited. But this is just simple maths. Current US unemployment, number of workers, Bureau of Labor Statistics thinks that the workforce is going to expand very slowly by 2024, probably not helped by visas and immigration bans and all sorts of other things. So net-net, the number of employed is going to grow by around 3.6 million over the next 8 years. That's a non-farm payrolls figure of 40,000 a month. Now, as soon as that figure goes below 100,000, the market has an absolute fit, thinking that the US economy is about to drop off a cliff. So employment growth, looking at these trend statistics, is going to be very, very modest. So again, for the US economy to suddenly start growing incredibly quickly, productivity is going to really need to improve very rapidly. And that is proving, for whatever reason, quite difficult right now. I guess probably shutting Twitter down would help enormously. But apart from that, it's difficult to think what might actually improve productivity. I'm sure things may come. Driverless cars, whatever it is, there will be something out there, but it's going to have to appear very, very quickly if the US can meet that 3% GDP growth number, because the employment statistics just aren't going to help you unless you let in an awful lot more people who aren't necessarily born within the borders of the USA. So the devil would say it's by no means all bad news in the US, but there are still some challenges that need to be encountered and need to be overcome. And the Fed, of course, has now got this very delicate balancing act. In theory, they're all gung-ho for tightening monetary policy. They want to put through 2 more rate increases this year. They may even want to start shrinking their balance sheet and sterilize QE, but as I've just suggested, the economic environment is perhaps more finely balanced than we would all like to think. And thank you to David Rosenberg of Gluskin Sheff, who points out of the last 13 rate hike cycles, 10 have ended in recession. The other 3, just to cheer you all up, ended in emerging market debt crises, so not too much to worry about there then. And if you look historically, it's been around 8 or 9 rate hikes that's tended to call the top for the US stock market. Wait, in the end, will stop trends. Rising interest rates will eventually slow the economy down and put the brakes on corporate earnings, particularly when American corporations have been on a massive debt binge. You don't need me to read that out, but you get the general gist. He's former economics professor at the Massachusetts Institute of Technology. So this is the Fed, and that's its balance sheet. There's QE1, QE2, QE3. As you can see, there's been a pause. Now, there was quite a strong correlation between stocks and QE early on, and this is growth, this is year-on-year change in the S&P and year-on-year change in the Fed's balance sheet. So again, good correlation. In fairness, since the balance sheet is flattened out, the S&P has put on a fresh spurt, partially helped by the arrival of the Donald as the president. So that correlation is not as strong as it was. So bulls will be taking heart from that. But again, to maintain this, because you've had such huge multiple expansion in the S&P 500, American profits quarterly are about 2% higher than they were in 2013. The S&P is up around 60% since then, so you've had huge multiple expansion. You now need to see profits coming through, whether that's from tax cuts, it could be about 15%, or whether it's from the US economy picking up or whatever, but it's got to come. And again, the provenance of those, slightly open to question. This just shows you the previous rate cycles back to 73. On average, it's taken about 8 to 9 rate rises to start to really slow down equities. And this is from Evergreen GavCal. And this just kind of goes through, again, none of us know what's coming. The Fed, very well intentioned, but run by human beings who are therefore capable of mistakes. And as Dawn Bush said, they've ultimately overcooked it 10 times in 13. So this is just a little bit of a guessing game. You know, where do we think things are going to go? Is the US economy going to go bananas, courtesy of the reforms from the Donald? Okay, fine. Those are perhaps potentially the asset class options available to you. Depending on then what the Fed does, will it start to tighten aggressively? Will it not? Will the Fed, in fact, tighten even if things start to slow down and go wrong? Then God help us, we could end up with actually a deflationary bust and probably the worst of all possible scenarios, in which case you need to be in bonds, dollars, quality defensives, and all those other things. And again, it gets pretty tricky down here. You're looking for safety. Here, you can afford to be a little bit more aggressive. So those are sort of potential scenarios. Inflation, deflation, stagflation. And nobody knows. None of us knows. We can all have a really good idea of what's priced in, and the other speakers will be much more attuned to that than I, because they're much closer to the coalface than I am. But that is a sort of potential decision tree that you are facing, looking at the monetary policy environment right now, looking at the economic environment right now worldwide, but with the Fed particularly in the box seat. And each scenario, in principle, means your portfolio needs to be tilted a certain way for a certain period of time. Okay, that's my get-out-of-jail-free card. I don't know which of those 4 scenarios is going to come true. One of them probably will. He was famous for all sorts of things. His other favourite one of mine is that restaurant, nobody goes there anymore because it's always full. Think about it. So how do you then tell which of those scenarios is going to start to play out, whether it's inflation, deflation, or stagflation? These are the 4 that I have on my screen. FTSE All-Share Mining Index and the copper price. Dr. Copper, great guide to global economic health. And right now, they're rolling over. It's not looking quite so good. That may be down to Chinese monetary policy tightening or what. But right now, that's not looking quite so good. And that has a knock-on effect on the Aussie dollar, which is also going down. So you'd say on the left, that's the market having some question marks over whether the inflation trade, Trumpflation trade, is really a winner. On the right, equally, Treasury prices have popped high from their lows last year. They've rolled over a little bit, but let's give them the balance of the doubt. And actually, the 10-year Treasury's gone high since that I drew that chart. The bond market's still sort of in inflation mode. And this is the US 5-year forward inflation rate expectation. Again, up way on high from where it was when Trump took over. Dipped a little bit recently and picked up again. Those will give you a pretty good idea for what the market's thinking. And right now, it was all pointing very much one way in January, February. It's just become a little bit more nuanced in the last month or two. The ultimate arbiter of any return you make from any investment is the price you pay for it, the valuation you pay for it. My favorite example I can no longer use because it's ARM. Because you could have bought ARM for 35 pence a share in 2003. You could have bought it for £10 a share in 2000, same company, slightly different price. And in the end, you could have sold out to the Japanese for 17 quid last year. Same company, just all in the price. But as you can see here, this is the US on Buffett's favorite metric, market cap to GDP. It's not been that much more expensive too often, but you can justify that on the grounds that US corporate profits as a percentage of GDP are quite near their all-time highs. So if you're a big fan of the old phrase, it's different this time, then you're absolutely in perfect territory here. And no less than Jeremy Grantham of GMO has argued just that in his latest blog, that US corporate profits are now at a permanently new super high level because regulation is creating quasi-monopolies for big companies and making it really hard for small companies to come up and get in the way. I don't personally believe that because it's different this time. And as Sir John Templeton said, the four most expensive words in investment are, it's different this time. So I'm not a fan, but if you believe that, you can happily pay these prices and happily accept that that is a new normal. Equally, you can look at the CaseShiller, which I know is a matter of religious debate amongst people. What I've just shown this is the cyclically adjusted PE ratio produced by Robert Shiller. It adjusts for inflation, it adjusts for long-term cyclical growth, it takes a 10-year earnings average, and this is just back to 63. That's the grey line. So again, we're up near some historic highs except for a particularly bizarre period here. The red line is then your 10-year compound annual growth rate from the S&P 500 subsequently. So funnily enough, the lower the price you pay, the better return you get over the next 10 years. I know it's easy, it sounds easy, but it's a lot harder than it sounds in terms of picking your times. But clearly, if you were to buy here, then you lost 5% a year for the next 10 years on average. And we're getting kind of to that territory right now. So again, on valuation grounds, there is quite a lot of good news priced in. And for the UK, I know I've not talked about the UK a lot, but because the US is currently the big driver of sentiment. But the UK market cap to GDP is also quite high. But again, corporate profitability is at record levels, so that is justifiable. What you need is that to kick on, stay where it is, go higher. We shall see. So how do you deal with all this? How do you invest in this time, which I personally think is a lot more uncertain than markets would currently lead you to believe? Now, as somebody who was a technology analyst for Warburgs and then UBS, there was somebody who in 1998 went, this tech thing's mad, and then managed to nearly get himself the sack for the next 2 years by being 2 years too early. My old rule now, subsequently, is when anybody starts talking about a bubble, add on 2 years, and then it might maybe get round to popping. So again, even if you think this is a bubble, be a little bit careful because things can run. But in the end, short-term noise will have a big say, and I would argue that Donald and populism, which you're going to hear an awful lot about soon, are clearly exerting an influence on market imaginations right now. But in the long run, we've really got three possible outcomes: inflation, deflation, or stagflation. As I showed you earlier in that decision tree, different asset classes have generally done better according to which of those options has come out. And this is where I return to this. Some of you have had the misfortune of hearing me present before will know that I'm a big fan of Dylan Grice's cockroach portfolio, which he devised in 2012. And he wrote an essay that was a paean to the cockroach, because the little beggars are rather difficult to kill. He actually did a piece on how long they can live without air, how long they can live without food, how long they can live licking the glue off the back of a stamp. It's all really quite a long time. And so the idea was to devise a portfolio that was similarly indestructible. And I'd imagine it took him a long time. But this is it, and I've sort of recreated it and back-tested it, and it's a 4-pot portfolio, which is hence the other half of the presentation title. And it's rebalanced once a year, and it's a portfolio in 4 equal dollops of equity income, cash, physical gold, and good quality bonds. Now, when I do this presentation to advisors, I get pushback on at least one of those buckets every time, except equity income. So if one of them is going to go wrong first, I know where my money is, probably equity income. But cash, very painful, very unpleasant. Gold, inert, if you trip over it, useless, no good to you at all. bonds. What, now, after a 35-year bull run? I'm not telling you that any of this is pleasant. I'm not saying that any of it is necessarily directly suitable for you, as per the disclaimer that I cocked up. But this is the historic proof that once you rebalance once a year, it's generally kept you out of trouble and also actually provided about 6% compound over a 30-odd year period. It's only had 2 down years as well, for good measure. And the rebalancing just means you take decisions that otherwise you would perhaps feel uncomfortable with just because of behavioral finance and the way the human brain works. So that's one possible option to approach current times that the devil would particularly say are perhaps a bit more uncertain than you might think. And in the end, again, none of us know. Doubt isn't much fun, but being certain you're right about something is probably quite a quick way to the poorhouse. So none of us know what's going to happen. We need to plan our portfolios accordingly for a range of scenarios, not just one. Politics is an additional complication, but second-guessing it, good luck to you. Because if the politicians don't know what they're going to do, then you certainly don't. So again, you need to be a little bit careful there. So ensure your portfolios are built to withstand a range of scenarios to protect your downside as well as your ups and generate some upside. Timing the market, good luck, but I wouldn't necessarily recommend it. And a mechanistic 4-pot approach may just work for you, but in the end, if you want to do stock picking, and I defer to the experts here, those are the things I always look for: Porter's 5 forces, competitive position management, and ultimately valuation. And it's hard work, because it is. That's why we have experts to help us. And it's valuation that really matters. So those are the disciplines that I would use in these currently deceptively uncertain times. As I said before, bubbles can be very cruel things. They tend to last a lot longer than you think, and the devil could be completely wrong with his timing. This is a chart that shows US GDP and then rebases US household net worth to it. So there's one stock bubble. There's another stock bubble with property thrown in for good measure. This, in time, one would expect to mean revert, and household wealth to go down as stocks go down and house prices go down. But even the devil doesn't know when. Thank you very much for your time, everybody.